Hello and welcome to the Tax Roundup. We'll be covering the important highlights for accountants and advisors across the month of July. This month we explore the evolving tax treatment of COVID-19 support payments to business and individuals. It's really hard at the moment to keep up with what's been announced versus what's been confirmed at law. And we'll look at the expansion of the taxable payments reporting system to sharing economy platforms from 1 July 2022. But first up, Michael Carruthers will take you through the updated guidance and the new draft ruling on the tax treatment of software.
Well, for some time, the ATO has indicated that it would be releasing at some time soon some updated guidance on the tax treatment of arrangements involving software. And that updated guidance has been really needed because the previous guidance that the ATO had in terms of the tax treatment of software had become pretty obsolete and outdated. The previous guidance was issued at the time when computer software was often sold in a physical format on a disk, that sort of thing. So we really did have this kind of bit of a gap in the guidance where most people were not selling software in that form, but the guidance was still based on an outdated idea of how software sales took place. Last month, some of you might have realised that the ATO released an updated draft ruling in the area of software and primarily focusing on whether payments relating to software would be treated as royalties or not. That scenario or that guidance is somewhat useful, but in a way a little bit limited in terms of who might be referring to it. Probably people who are cross-border arrangements would find that guidance probably more relevant to them, but it could also be relevant in some situations where we have companies and looking at whether the income they are deriving is classified as base rate entity passive income or not. Now, more broadly, the ATO this month has released some guidance on the website. It's not in the form of a public ruling as such, but website guidance that really focuses on this issue of whether software should be treated as trading stock or as a depreciating asset for tax purposes. And that classification of software for tax purposes can be really crucial in how we approach and deal with the tax issues for software. The ATO confirms that if you are developing software with the idea of disposing of the copyright in that software in the ordinary course of business, then it's probably trading stock, in which case you would apply the trading stock rules. Gains would be included in assessable income, taxed on revenue account, basically. But what a lot of clients get involved with is developing software, for example, apps, where they intend to retain the copyright in the software and to derive an ongoing income stream from licensing or allowing other people to use that software. In that case, it's less likely the software will be classified as trading stock for tax purposes. And in those instances, it's much more likely that the software will be dealt with as a depreciating asset under the tax system. Now, that has a couple of implications. The first one is, right now, we've got some temporary full expensing rules. We've had some kind of recent instant asset write-off rules, some accelerated depreciation type provisions as well. If software is treated as a depreciating asset, for some clients, there will be an ability to claim an upfront deduction or quite fast deductions in relation to the costs incurred in relation to, for example, creating that software. Probably one area just to be a little bit careful of is if you do have clients who are using the, for example, simplified depreciation rules, be aware that there is an exclusion from those rules for assets subject to a depreciating asset lease, and where you're licensing software to other parties, it could potentially fall within that category. So bear that in mind. So that's one, I guess, implication of software for some people being classified as a depreciating asset, that there may be an opportunity to take advantage of things like the temporary full expensing rules at the moment. The other thing just to be aware of is that if the software or the copyright in the software is dealt with as a depreciating asset, if your client does end up selling that software and making a gain from that, it will typically end up being taxed on a revenue account basis. And that's because when we have sales of depreciating assets, they're dealt with under the balancing adjustment rules, and if a gain arises, it will typically be included in assessable income. Now, what that means is that you can't normally apply things like the CGT discount or the small business CGT concessions. So a couple of things, pretty important things that come out of that classification of software as being trading stock or a depreciating asset, it's pretty unusual for software actually in practice to be dealt with under the CGT provisions. So a couple of important things to keep in mind there. It's good that we now have some updated guidance in this area. As I said, the previous guidance was pretty outdated and very difficult to, I guess, reconcile to what actually happens in practice these days. So good to see that there. And if you do have clients who are involved in developing software, developing apps, either to sell the copyright or to derive an ongoing license fee stream, that is probably the place to turn to in terms of where the ATO's updated guidance is.
And if you need more, Michael will be hosting a webinar on the tax treatment of software on Thursday, 19th of August. Don't miss that one. And now across to Matthew for an update on the tax treatment of COVID-19 support payments.
Now, with a number of government support payments being introduced more recently in response to the various COVID-19 lockdowns, if you haven't already, you're probably going to start getting some questions around their tax treatment. The way it should work is that if you're dealing with an employee and they've received some government support payments to replace lost wages that would have otherwise been accessible to them, then the starting point is that that support payment is also very likely to be taxable to that individual. On the other hand, if you're dealing with a business client and they've received some government support payments to help them with their business operations, then it's also very likely that that support payment should be taxable to that business. That is unless a specific exemption applies, which is very dependent on the type of support payment itself. So just as recently as yesterday morning on Thursday, the Prime Minister did mention to the media that the more recently introduced COVID-19 disaster payments would be tax exempt. These are the weekly support payments being made to workers, as well as potentially sole traders who've lost hours because of the restrictions caused by the lockdown, and where they also meet a number of other conditions as well. It's just all a bit preliminary at the moment, but hopefully we'll get a bit more certainty and more details on this tax exemption soon. Now, what's more targeted towards businesses is that there was some legislation that was passed last year that provides a tax exemption for certain state-based COVID-19 support payments where they're received by businesses with a group annual turnover of less than 50 million. Now, originally that exemption only applied to support payments received in the 2021 income year, which probably wasn't all that appropriate, just given where we're at with the various lockdowns and restrictions at the moment. So what's developed since then is that this exemption has been extended one more year to grants potentially received during the 2022 income year. Now, the tax exemption itself is very targeted and sensitive to the type of support payment. Originally, there were only 6 specific support payments, Victorian support payments, that were eligible for the exemption. That's just been more recently expanded to include another 7 other specific state-based support payments, although still all Victorian. Now, having said that, the good news for New South Wales is that the government has announced that it's intending to make the more recently introduced New South Wales small business support payments tax exempt also. There hasn't been any legislation introduced yet. So again, hopefully we'll see this quite soon and we'll get a bit more of a clearer idea of what's specifically covered and what's not. Ultimately, the key message here is if you've got a client that's received some support payments to replace lost wages or to help them with their business operations, then the rule is that the payment itself is very likely to be taxable unless a specific exemption applies. If you're looking at the Victorian business support payments, then this might be possible depending on whether the support payment itself falls within that prescribed list, as well as the client's group annual turnover. On the other hand, if you're looking at the more recently introduced COVID-19 disaster payments and the New South Wales small business support payments, then hopefully a tax exemption will be formalised soon. And I just watch this space a bit more carefully as more details emerge.
And back to Michael on the expansion of the taxable payments reporting system to sharing economy platforms.
We know from guidance issued by the ATO in the last few years that there has been an increasing focus on the sharing economy by the ATO. And if you look on the ATO website, you'll see quite a bit of guidance that the ATO has issued over the last couple of years on a range of different ways of earning income through the sharing economy, whether that's through things like ride sourcing, short-term accommodation, rental arrangements, asset sharing, food delivery, all sorts of things that people can get involved with in connection with the broader sharing economy. And you'll see if you have a look at that ATO guidance that in most cases there's an expectation that income derived from participating in the sharing economy will typically need to be included in assessable income and will be subject to tax. Now, while that guidance is pretty clear, clearly there is some concern that people are still not including that income in their tax returns and being taxed on it appropriately. And the reason I say that is because we've had quite recently the government indicate to us that some further measures are going to be put in place in terms of how the tax system works around the sharing economy. And it looks like the way that's probably going to be dealt with is through an expansion of the taxable payment reporting system that applies to payments to contractors in certain industries. So the proposal is that from the 1st of July 2022, that platforms that basically relate to the sharing economy in the ride sourcing and short-term and accommodation sort of area will need to provide certain details to the ATO in terms of who is receiving payments through those platforms for ride sourcing or from providing their accommodation for reward, deriving some sort of income from that. Now, from 1 July 2023, the guidance at the moment from government is that that system will then be expanded out to include other aspects of the sharing economy. That could include things like food delivery, asset sharing if you've got a caravan or trailer that you might rent out from time to time through a platform, an online platform. Those sorts of things will move into that system a year later. Now, in a sense, it doesn't change anything from a tax point of view because these things should already be being taxed. It really is that reporting obligation and the ability of the ATO to identify where people have received payments but are maybe not including those in their tax returns as income. The ability of the ATO to pick up on that in a pretty easy way, really, is going to improve with the introduction of this system. Now, we're still waiting for full details of that expanded system to be released, but it is worth just being aware. And, if you're aware of clients who are involved in some way in the sharing economy, whatever that looks like, hopefully already you've told them kind of how those things should be dealt with from a tax point of view. But it might be worth also just reminding them that the ATO is stepping up its efforts and the government is stepping up its efforts to make sure that that income is recorded. So we'll probably find out a little bit more about that expanded system as 1 July 2022 approaches. It seems like the onus really from a reporting point of view will be on the platforms that kind of host those sharing economy activities. But clients who do earn income, even if it's a relatively small amount, I guess the risk is increasing. If they don't report that in their tax return in the near future, it will be much easier for the ATO to figure that out and to then take appropriate action on that.
That's all we have for this month's Roundup. It's a feast of change for accountants and advisors at the moment. We'd love to show you how we help thousands of accountants across the country keep on top of change. Give the Knowledge Shop team a call on 1800 800 232 or visit the website and book a time to take a tour online. We'll look forward to speaking to you soon.